Welcome everyone to World of Concrete and CC Live. Hope you're having a great time. We have a special treat here this afternoon. Pierre Villere is a longtime columnist for the Concrete Producer magazine, published by Hanley Wood, and he's the managing director of Allen-Villere Partners. He conducts the NRMCA's annual data survey every year, and right now he's going to talk to us about the state of the industry. And stay tuned, we're going to have parts 2 and 3 in a little bit. I'll turn it to you, Pierre.
Thank you. Thank you. As Tom mentioned, we're going to do this in 3 parts, which is 3 little 10-minute sessions. I'm going to start with an overview of the industry. So with that, let's get started. And I just want to make a comment that there are some numbers we will be publishing here, and that all of what we show you is in compliance with World of Concrete's antitrust policy. So let's take a short look at the highlights of our ready-mix concrete world. And I'll start by saying the ready-mix concrete production has continued to grow, but slower than we all thought the pace would be. Let's look at this historically. In 2005 and 2006, we reached the all-time high of 256 million and 258 million cubic yards. We believed during that time that there was actually 500 million cubic yards of demand, and the industry was so stretched thin that it couldn't support anything more than the 450 million cubic yards that were being produced. Every single driver, every single mixer truck, every pound of cement was being employed in the economy, and the industry was running flat out. In 2007, the first shoe dropped. This is really a very interesting statistic. We dropped to 414 million cubic yards. That was a 40 million cubic yard contraction, and it was the largest single contraction, 10% of the prior year's production. It was the largest contraction since these numbers were, we started tracking these numbers at NRMCA in the mid-1970s. That 40 million cubic yard drop was largely attributable to the drop-off in new housing construction in all of the hot markets that tanked in 2007, which was Florida, Arizona, Southern California, and Las Vegas. The following year, things got worse as commercial and public work slowed down dramatically, and we dropped to 351 million cubic yards. If you remember, at the end of 2008, that was the financial bust. And so the following year, we saw another drop of almost another 100 million cubic yards to 258 million cubic yards. We stayed on the bottom for a couple of years there, and then slowly turned the corner in 2011 when volume started climbing again to 265 million cubic yards. And then we went to 289 in 12, 300 million cubic yards in 13, and 324 million cubic yards in 14. So the recovery has been relatively slow, and we think the final numbers for 2015 will bring us in at about 330 million cubic yards, which is flat if you consider that 2014 was 325 million cubic yards. This is down from a prediction we made last year of 350 to 360, 350 million to 360 million cubic yards, as we witness a pause in an already slow recovery. There's 1,000 reasons why things are not accelerating at a faster rate. We're going to show you some NRMCA data. I participate on the committee. My late partner, Bill Allen, actually started this survey for NRMCA in the early 90s. And we are showing you some limited data that is, it's an effort to demonstrate the value of survey participation. And as a result, we want to be clear that this is being used with NRMCA's permission. It's their property, and it can't be duplicated or used again without their prior permission. So, but I would like to say that if you are a producer and you'd like to participate in the survey, please contact NRMCA. You can contact our firm. We provide all these services pro bono to the industry, and we will be happy to help facilitate your participation in the survey. It's filling in a questionnaire, and It's some time, but it's nothing that's terribly daunting. What are the big three takeaways for the 2014 results? And let me explain something here for a minute. We're seeing the 2014 results because we collect that data in the spring of 2015, or the spring of each year, the prior year data, and then that it is assembled through a third-party accounting firm in the summer, and then it's released usually around Labor Day. So we're seeing the results of 2014 here. There was a lot of good news in 2014, and when we see the results again in 2015, for 15, this summer, we think we'll see some additional improvements. The first one was that the top-line selling price took the biggest jump ever, adding $4.81 to the selling price over 2013. That was significant. The industry returned to profitability for the first time, as we had predicted, swinging from a $2.23 net profit from a $1.03 loss in 2013. The industry increased EBITDA to 71%, to $6.60 from $3.87 last year. So it almost doubled EBITDA in 1 year, which was a significant positive. So let's take a look at some of this 2014 data. We call this the 2015 survey, but it's presenting the 2014 data. Just want everybody to know that NRMCA, we've worked together with the Justice Department as it relates to antitrust considerations. We have Covington and Burling as a law firm in Washington, D.C. that vets the questionnaire every year to make sure we're not crossing any antitrust lines. Confidentiality is a big issue. I mean, a lot of producers get concerned about the prospect of their information falling into a competitor's hands, and that's simply not the case. No one at our committee, the Business Administration Committee, or in the NRMCA sees the individual company data. It all goes to a third-party accounting firm, and the third-party accounting firm gives us, the committee, we see the raw output, and we don't see any individual company's data. And so, as I mentioned, an outside CPA processes the information, and this is to ensure the privacy of your data. Okay, member participation has grown, and I think this is important to note. You'll see that the number of participants here in the survey has gone up to 192 in 2014, which is the latest year, down from 199 the year before, but significantly improved over 2012 when we were at the height of the recession. But most significantly, last year, this is the 2013, the number of yards that were covered in the survey was 100 million. It was 111 million this year, and I would tell you that that is a significant sample when you remember that we saw just a few slides ago that the industry only produces about 330 million cubic yards a year. So fully 1/3 of all the concrete that is produced in the United States is represented in this survey. So we think it's a significant improvement. Okay, participants receive up to 4 reports. You get a customized report that compares your performance to your peers by size and geographic region. You get a detailed report, a quick reference executive summary, and your company compared to your state, compared to your region, and the typical NRMCA member and upper and lower quartiles if you are at least, if you have at least 5 participants in your state. Oops. These are currently the states that are that have individual surveys, and there's a handful of states where we're getting 3 and even 4 respondents, and we're trying to find a 5th respondent. In those states, there are probably another 6 or 8 states that are close to getting a statewide survey. You can well understand the value to an individual producer if they have individual state data. Okay. All right. We started something new in 2015. It is a key metrics report. This comes out monthly. It's on a 12-month rolling basis, so it's a TTM, or what we call trailing 12 months in the investment banking world. And these are the metrics we're measuring. The participants tell us it takes them 5 minutes to fill in this survey. These are controllers and CFOs at participating companies. Here are the metrics: volumes, price per cubic yard, material cost per cubic yard, number of licensed and insured trucks, and mixer utilization, which is cubic yards per truck. So that information comes out every month, and if you participate, that information is available to you. We have 65 participants. We'd like to get this up to a couple of hundred participants among our NRMCA members. Okay. I put this smiley face here because you can see this was a pretty significant grim period here from 2010 to 2013 when profit before tax per yard fell to as much as $7.27 in the red. And last year, in 2014, I should say, profit turned into the green at $2.23. EBITDA per yard is even more impressive. You could see there was a 34-cent loss in 2010, and in each of the additional years since the recovery started, we're seeing significant improvements in EBITDA, which is earnings before interest, taxes, depreciation, and amortization, which is the free cash flow a business generates for its shareholders. Okay. Price and cost leverage drove the improvement. So we'll see very quickly here, because I don't want to run too heavy. In 2014, you can see that we had a $2.10 improvement here on material margin. And as we come down here, you'll see that we went from $1.03 in minus profit before tax to $2.23 in 2014, which is a $3.26 improvement. Pretty significant swing. Not everyone is average, though, and these next two slides are very important because they point out the disparity in the industry. Here is the average NRMCA member at $2.23 in profitability. The bottom quartile still lost $9.20 in 2014, while the upper quartile earned $12.16. This is profit before tax. As you'll see here, that's a $21 swing. That means 25% of the industry is operating here, and 25% of the industry is operating here, and the middle, the 50% in the center, is operating around in here. So there is still some unhealthy trends that are occurring in the industry. And as you can see from this comment, the top quartile was significantly more profitable. Let's take a look at how the top quartile did it. It's always in the selling price. Look at this. The average NRMCA sold concrete at $98.23. The upper quartile was at $105 for a $7.02 advantage on the top line. And as you can see, that goes from a $2.23 profit to a $12.16 profit, which is $9.93 difference. Most of it is driven by this right here. It's always in the top line. The markets where the producers get the most for their concrete tend to be the markets where they're the most profitable. Okay, I'm going to jump through this. All right. Here's how the bottom quartile missed. And you can see it starts with a very poor selling price. So while the average again was $98.23, they were only getting $95.78. So they have a $2.45 disadvantage. And if you recall, the top quartile is getting a full $10 a cubic yard more than they are. So you'll see that their profit before tax was minus $11.43. So I'm sorry, $9.20, but it's an $11.43 differential from the average. So they've got a lot of ground to make up.